I might just spend a bit of time talking about the loans sort of settings at a really high level. I think some of these sort of things are important. Certainly you might apply because you have obviously a financial need. It might be for, and I won't go into too much detail, I will a bit later, for either just refinancing, but also for paying bills and operating expenses, but also to invest into capital, whether it be new technology, new equipment, new machinery. Certainly everything is included. And the way I sort of talk about it is it's probably easier to think about it in terms of what you can't spend it on rather than what you can. So what you can't spend it on is to pay taxes or for personal expenses, so buying a sports car or something that's totally unrelated to the farm business and tax, they're out. Pretty much everything else is in. It's fairly broad the way we've set it up in terms of what the money could be spent for. The interest rate is 3.58%, and that's just reviewed every 6 months. And it only moves if interest rate moves. So that's the only reason it would move. So if interest rates went up, it'd go up. If they went down, it'd go down. That's the only thing that sort of triggers it, but it's only done every 6 months, the review. The loan term's 10 years. 10 years. First 5 years are interest only, and the second 5 years the principal starts to be repaid, but not all of it. We expect about 50% left at the end of the 10 years for refinancing. And that's back to that partnership thing. We think it's a partnership arrangement where there will be some refinancing at the end of the 10-year time because we don't expect it to be fully repaid. And if you think about it, we're trying to help farmers or farm businesses that are in financial need because they're doing it particularly tough for any reason. I'll talk about the reasons soon. That this finance enables them to get back on their feet, get back to viability, and start to pay some of the principal back, but not all of it because it might take quite a while to sort of turn things around depending on the conditions. The repayment frequency is just tailored to the business, so it depends on the income streams for the business, how they're factored in, depending on if it's cropping, cattle, when the sales are, so it'll be tailored to the business. If there's 2 major income streams a year, then that's when the repayments will be. An important part of the criteria is that 50% of your debt must be with a commercial lender. So quite simply, if you did borrow $1 million from the Regional Investment Corporation, you'd need to have $1 million with a commercial lender. Likewise, if you borrowed $500,000, you'd have to have $500,000 with a commercial lender. We don't want to be the only person in the equation. That's why I talk about a partnership. It's helping out in the times of need, but maintaining that commercial relationship that you might have with a commercial lender is an important part of it. So that's at the time that you apply. No ongoing fees and charges, so no application fees, no monthly charges, no early payment fees. Might be some statutory costs in terms of title, searches and that sort of thing that are standard costs of when you're pulling a loan together, but no ongoing fees and charges. So the maximum loan amount as of now is $2 million. So if you did lend that $2 million, like I said before, you'd have to have $2 million with a commercial lender to be eligible.